AM Best has released revisions to its Best Credit Rating Methodology, or BCRM, and its criteria procedure on available capital and insurance holding company analysis. Here to talk about these revisions is Mathilde Jakobsen, Senior Director, Analytics, and Tony Silverman, Director, Credit Rating Criteria Research and Analytics. And Tony, we're going to start with you. Can you explain briefly the main updates made to BCRM?
Thank you, John. The BCRM has been revised to make more explicit and slightly increase, in fact, our consideration of the nature of the regulation of insurance groups, and to keep that in mind in our notching of non-operating insurance holding companies. That's the notching down from the lead rating unit in the group. And what's happening is we're going to have two classifications of insurance groups. Firstly, there's the familiar picture of a group where regulation is focused on the individual insurance company legal entities, and where there are significant regulatory restrictions on removing capital from a regulated insurance entity. We're now calling these groups where the entity is prioritized in the regulatory environment. We're going to call them entity prioritized structures, or EPSs. And this remains our default classification, and the notching to a non-operating holding company from the lead rating unit is unchanged, typically 3 notches for these groups. Nothing changes there. And almost all US-based groups, I should add, would be in this category, for example. What's changing is where the interaction of a group's regulatory environment across its footprint with its own capital management policy means that the group's capital is to some degree more of a collective asset of the group. And so where the capital is more fungible across the group, which is to say it's available to meet the requirements of the different insurance legal entities in the group as needed, then in those circumstances, we may classify such a group as a collective capital management group, or CCMG. And such a group would normally be subject to effective regulation of the group, including of its consolidated balance sheet. And that would be an important focus of CCMG's regulatory environment. And the changes to the BCRM mean these groups, CCMGs, would typically have a 2-notch gap from the lead rating unit to the non-operating insurance holding company's ICR. That's instead of the 3 for the EPSs. Legal entities in CCMGs would continue to obviously meet minimum requirements, of course, but typically excess capital is more likely to be held higher up the organizational structure. And this is all sort of makes sense because at the end of the day, a greater focus on group regulation rather than the individual legal entities does bring the holding company and the insurance operating subsidiaries that bit closer together in terms of stakeholders' solvency risk. So we're reflecting this in a more explicit consideration of regulation in the holding company notching. But I should say that group regulation, especially across national boundaries, is certainly still a developing form of supervision. It's on a journey. Legal entities remain very important. But we've assessed that group regulation has reached a maturity now, for example, within the EU, to mean that it's right now for us to take this step. But to be clear, we're not classifying regulators. We're classifying insurance groups. It's largely determined by the regulatory environment, but the capital management policy of the group itself is an essential part of the classification exercise. And finally, the other change that's being introduced in the BCRM is provision for a widening of the notching on debt issued by an insurer subject to loss absorption triggers, where that trigger is not sufficiently remote. In other words, a security where payments, whether of coupon or principal, can be deferred or skipped completely whilst the insurer continues to trade. That sort of security might see its notching as a result of these changes widened by beyond what its stated subordination on a wind-up would suggest. This would happen if the trigger for skipping payments is no longer particularly remote.
So, Tony, how do you foresee this impacting credit ratings?
Well, the number of existing published ratings of non-operating insurance holding companies that will be affected at the end of the day is really very limited. We've said that less than 5% of ratings will be affected, and I think that's undoubtedly the case.
Mathilde, can you talk us through some of the changes to the available capital and insurance holding company analysis criteria, as it will now be known as?
Yes, thank you. So we made revision to this criteria primarily for the purpose of clarification and transparency, and to ensure that the criteria is up to date in reflecting the hybrid debt features we see in the market. So I'll mention a few of the changes that we've made. So one area is a clarification of the discussion of senior debt, and specifically a clarification of our approach to giving equity credit for senior debt in available capital in best capital adequacy ratio, or the BCAR as we call it. So we give credit for senior debt, downstream senior debt, for insurance companies that are part of enterprise prioritized structures, as Tony set out earlier. And we do that in cases where there is strong regulatory restrictions on the upstreaming of funds back from the operating insurers to their debt issuing holding companies. That creates what we would call strong structural subordination of the downstream debt funded capital, justifying equity credit in the car. Another revision that we've made is on perpetual preference shares. Here, the revisions allow increased flexibility on the treatment of preference shares that have features that are aligned with those of common equity. The changes to criteria will allow increased flexibility. It will allow us to treat some preference shares as capital, not debt, and therefore avoid the caps that we put on credit for debt, both in the leverage and in the capital adequacy calculations. In addition to those two big changes, we've also updated language on a number of issues. One of them is the language on how we look at call dates for debt to reflect some of the differences in the approach that we see carried with them from different investor expectations and whether call dates have to be met or not. And we've also updated the language when we talk about the amortization of credit for debt in the car for hybrids that have a limited time to maturity. Those are the main changes we've made.
And Mathilde, do you foresee the changes to this criteria procedure resulting in changes to any published ratings?
The changes, as I said, are mainly clarifications and a better expression and updating of the language we use to explain our approach. So we don't foresee any changes to credit rating as a result of these revisions.
That was Mathilde Jakobsen, Senior Director Analytics, and Tony Silverman, Director Credit Rating Criteria, Research and Analytics. You can find the revisions to the BCRM at ambest.com. For AM Best TV, I'm John Weber.